Yeah, it wasn't hard to persuade me to come to Bournemouth. I didn't realize that it was going to be quite so difficult to see the beach or to participate in it, but it is. I wanted to come. I was very honored to receive this invitation from the local government association, and really wanted to make sure I could come because of the importance of what you do across the country, and the support the LGA provides to councils to make sure that you have the skills you need to deliver the services that our citizens demand, and to make sure your voice is heard at the national level. And I think you're going to get a chance to have your voice heard at the national level. Well, you're going to have a chance in the Q&A here, but with some other speakers who are coming after me. Look, the closest I'm going to get to the beach today is to use a nautical analogy for my speech, which is a sea change. So if you'll bear with me on that. And of course, the sea change is a profound transformation. It's a term originally coined by Shakespeare in The Tempest. And I note that there are 11 productions of The Tempest in the Southwest this summer, 5 of which are in Dorset. So if you want to brush up on Shakespeare, there are ample opportunities. And of course, it's a play that mixes tragedy and comedy and has themes that range from magic to creation to betrayal and revenge. My focus, as I said, you're going to get a chance to raise your issues later on. My focus is more limited and prosaic, my focus on a sea change, but it's also, I think, more relevant to your work. But I'll start with an apology because, well, this is local and you are all about local. I am going to start at the global because the sea change about which I'm going to speak has been the sea change in recent months in financial markets, driven by growing concerns over the global outlook. And what I want to do is talk about what's happened, assess those developments and what they may mean for the UK economy. Now, over the course of the past year, the expected paths of monetary policy interest rates, so the interest rates that are controlled by central banks across the advanced economies, have shifted sharply lower, most notably in the United States. A year or so ago, expectation of a few further rate increases, those have flipped, where the expectations now are 4 rate cuts over the course of the by the end of next year. And in the euro area as well, the markets have begun to price in rate reductions and further asset purchases. In tandem with this, longer-term bond yields have fallen sharply. 10-year U.S. yields are at their lowest rate in 2.5 years. 10-year gilt yields are their lowest since the immediate aftermath of the referendum. And German bond yields are their lowest ever. An incredible $13 trillion of global investment-grade debt is now trading at negative interest rates. And those lower interest rates, yes, it is actually an incredible figure. It sounds like a lot of the things I say sound like they're big numbers, but they're not. That's really a big number, and it is an unprecedented situation. I'll try to signal the difference between the two. So there's this fall in interest rates is what has been supporting equity prices, which are near all-time highs in the U.S., despite an economic outlook which is becoming much more uncertain, much less robust. And I'd argue that these market developments reflect a sea change in the expectations of the outlook for trade and policy in general. So rising trade tension, rising policy uncertainty. And certainly the portents are worrying. The storm that the modern Prospero has conjured is beginning to have its impact on the global economy. Over the past year, the global economy has shifted from a robust, broad-based expansion to a widespread slowdown. A year ago, if I were here, I'd be pointing out that 4/5 of the global economy is growing above its trend rate, its speed limit, if you will. The current proportion is 1/6. Now, back in May, start of May, we projected, the Bank of England's MPC, who sets interest rates, we projected that global growth would stabilize before recovering a little bit around the middle of next year. And that mild optimism, it was only mild optimism, was based on a few factors. The first was that there aren't really big fundamental imbalances in the global economy at present. The kind of things, excess inflation, for example, or huge excess personal debt, the kind of things that would cause recession in and of themselves. Secondly, there's quite a large degree of expected additional policy support, the charts I showed you at the start. And thirdly, at that time, there was the beginnings of positive momentum in trade discussions, particularly between the US and China, and of course the new NAFTA agreement had just been signed. But on the 5th of May, with the ink on the inflation report barely dry, President Trump announced further increases in tariffs on US imports from China. China retaliated. Later that month, the US additionally threatened new tariffs on Mexico, despite having only recently signed a revised NAFTA accord, and the US threat to increase tariffs on European autos remains in the air. These latest actions raise the possibility that trade tensions could be far more pervasive, persistent, and damaging than previously expected. And certainly, the rationales for trade action are broadening. Initially, they were motivated by concerns over bilateral trade imbalances, but measures are now being taken in response to issues as far-ranging as immigration, protection of intellectual property, control of the technologies that underpin the fourth industrial revolution, and it's even become fashionable for some to talk of a new Cold War. And that last rationale bears a moment's reflection of what's at stake. For a lot has changed in 3 decades. At the height of the Cold War, US-USSR trade was worth $2 billion a year. Today, the US and China trade is $2 billion a day. More broadly, trade in intermediate goods and services have doubled since the fall of the Berlin Wall, and production, as I think we all know, is increasingly integrated across borders. It's also an issue that the longer current trade tensions persist, the greater the risk that protectionism becomes the norm. Once raised, tariffs are usually slow to be lowered. Consider that about 50 years ago, during the Johnson administration, the US put tariffs on light truck imports from Europe in a dispute over chickens. The chickens, soon forgotten, those tariffs are still in place. Now, reflecting this atmosphere, trade concerns about a trade war have shot to the top of the risks that are most worrying investors. And measures of global economic policy uncertainty have reached record high. Such concerns are contributing to sharp reductions in corporate earnings expectations, though for a time being, as I said at the outset, the fall in interest rates have supported equity prices, suggesting the market's faith in the power of monetary policy that is notable. Business confidence has fallen across the G7 to its lowest level in 5 years, with sentiment amongst manufacturers particularly weak. Households have become more concerned about the economic outlook, though they remain relatively upbeat about their own personal prospects, likely reflecting the strength of labor markets. I'm going to suggest that what we're seeing now globally is similar to a pattern that has emerged in the United Kingdom following the referendum. And so to start to move from the global towards the local, I think the question is that given that risks have clearly shifted to the downside in the global economy, how big a shift has happened, to what extent, and what does the UK's experience in recent years suggest? Now, a lot, of course, is going to depend on not just the scale, but the breadth of those trade effects. And when economists look at traditional models of trade effects, so if we just sort of flow through the effect of a higher tariff, the likely impact of the measures implemented thus far is likely to be small. Bank of England estimates are that these measures will reduce global GDP by only 0.1%. The further tariffs that have been discussed in recent weeks between the US and China would roughly double that. But the issue is that's not necessarily the end of the story. There's more in train. There's more that's been tweeted and debated that, if put in place, would raise US tariffs to the highest level in over half a century. And if those were put in place, they would reduce global GDP by 0.6% again, just through a direct trade channel alone. Those estimates probably don't take into account the interconnections in the economy, the supply chain effects I mentioned earlier. And it has to be said that the early indications of the impacts are not promising. The more hostile and uncertain trading environment is coinciding with a sharp slowdown in trade. Remember, a lot of these have been threatened, not acted, but trade is falling. Manufacturing, industrial production, and capital goods orders. And as a consequence of all of this, the quality of global growth has deteriorated. It hasn't just slowed, but the quality has gone down. The growth rate of business investment in the G7 has halved since its peak in 2017, and we have a global expansion that is much more reliant on household spending. And history tells us that that is an expansion that's much less resilient. Now, the experience of Brexit suggests that the indirect effects on business confidence, and to be clear, of uncertainty on business confidence and investment can be much more material than these direct trade effects. UK business investment has flatlined since the referendum, underperforming both previous recoveries and the international experience. So the swathe is what normally happens. The flat line is what has actually happened. There's also evidence, increasing evidence, that uncertainty is holding back foreign direct investment. And so what if we take this UK experience, which I'm about to do, I'll do it quickly, take that experience and look at what's happening globally to assess how much these types of uncertainty effects are in place. And if I take, there's various ways to measure the uncertainty effect on UK investment. I won't bore you with them. I won't bore you anymore with them, but they're available in the published version of this. But they average to about a 12% hit to business investment caused by that uncertainty over Brexit. The scale of the moves in interest rates, those huge moves in interest rates, suggest a shock to US and Chinese business confidence that is on the same order of magnitude of what has happened here. So that's big. And in fact, you can argue, and I would argue, that that is probably a bit extreme, that those effects should be as large between the US and China, because those two economies, even though they have $2 billion of trade a day, those are big economies, and they're much less integrated than we are with the EU. For example, well, 45% of UK trade is with the EU, under 20% of the US's trade with China, and only 7% of China's trade is with the United States. So it's possible that something else is going on top of the trade tensions, including concerns about the still quiescent inflation in major economies and the related risk of a global liquidity trap. In the United States, core inflation fell back below the Fed's 2% target earlier this year. In the euro area, core inflation's been hovering around 1% for much of the past 5 years. And for both of these economies, market measures of long-term inflation expectations have been drifting down over the course of the last year. Now, you have a potential combination of persistent low inflation and a risk that the so-called equilibrium level of interest rates, in other words, the rate of interest that's consistent with inflation being at its target, 2%, and the economy operating at full capacity and the labor market being in full employment, that rate is lower than currently assessed. And the fact is that trade tensions and wider uncertainty have the effect of pushing down that equilibrium interest rate, which makes it harder for monetary policy to provide the support that the economy needs. And this increases the desirability that fiscal policy supplement monetary policy if, and I stress the if a downturn were to materialize, and I'm speaking of other economies than the UK. So now, having made that transition of what can the UK teach the global economy, if you will, what does this potentially mean for us? Unlike many other jurisdictions, inflation in the UK is currently at the MPC's 2% target. I'm just going to repeat that. It's currently at the MPC's 2% target. We have to enjoy it while it lasts. But more importantly, more fundamentally, the labor market in this country is tight. Wages are growing at around 3.5%. Unit labor costs, so the combination of wages and productivity, are running at rates that are consistent with that 2% target, and the expectations of households and businesses remain well anchored, the expectations around inflation. Now, in the short term, Brexit effects have been more pronounced, and the data has been more volatile as we had expected, as the uncertainty around exactly the path of Brexit increased. What happened in the first quarter was the economy grew about 0.5%, and that was importantly boosted by the contribution from companies bringing forward production to build stocks in advance of the March 29th date, just in case there was frictions at the border. But bringing production forward means that you lose production afterwards, and the second quarter was where that loss will be felt. We expect the second quarter to be considerably weaker. We won't have that stock building effect. And in addition, several major car manufacturers in the UK shut down production in April. Again, just in case there were frictions at the border is a logical thing to do, but it means that there's not that activity from autos. But looking through everything, surveys are pointing to effectively no growth in the second quarter in the UK. And that suggests, to me at least, that there's something else going on, and that part of that something else could be negative spillovers from this drag from a weaker globe. In my view, the underlying growth in the United Kingdom is currently running below its rate of potential, and it's increasingly reliant on the resilience of household spending. Now, the intensification of these global trade tensions have increased the downside risks to both UK and global growth. And just to put some numbers around it and sort of recap what I was saying with the various calculations, the direct effects of these measures is pretty marginal for the UK, a little less, about 0.1%. And that's partly because we will benefit from lost trade between the US and China over time. If all the measures come in place, it becomes more significant, about 0.4%. And if that Brexit-style confidence effects were to take place between businesses in the US and China, the total impact starts to be material at over 1% of UK GDP. So with that backdrop, since the middle of last year, expectations of UK interest rates 3 years ahead have fallen by around 0.5 percentage point, and 10-year gilts have fallen by roughly the same amount. And that would be enough, those moves in and of themselves, in our judgment, would be enough to offset the hit to UK GDP in that downside scenario where there's significant, if I can call them Brexit-like confidence effects on US and Chinese businesses. But of course, what's happening outside of the UK is not the only factor influencing developments here, particularly UK financial conditions. These remain highly sensitive to perceived probabilities of Brexit outcomes. And that reflects the fact that asset prices are mean expectations. So in other words, financial markets weigh all different possible outcomes and take an average of their viewpoint. And in the past few months, what's happened is that markets have placed an increasing weight on the possibility of a no-deal Brexit. In fact, betting odds, as one example, have doubled to about a 1 in 3 chance. So what's happened is markets have marked down UK equity prices relative to everyone else, sterling, and also their expectations for what the Bank of England would do with interest rates. Now, well, the MPC, to make it clear, the MPC will do what it can to support the economy if there were no deal. But I do want to underscore the MPC's caution, and we've consistently said that our response to Brexit will not be automatic. Let me explain why. We've repeatedly emphasized this. The response will depend on the balance of the impact of Brexit on sterling, the exchange rate, on demand, which is normally what happens when you have some sort of shock, demand goes down, but also the supply of the economy, the capacity of the economy, because there will, for a period of time, be an adjustment there. And there's little that monetary policy can do. We can affect demand, we can influence the exchange rate, but there's little we can do to affect the capacity of the economy certainly in the short or medium terms. We don't build factories, we don't reskill workers, we don't open up ports, whatever the level of interest rates. And it bears remembering, and this is a point both from a global perspective and a local UK perspective, that a large negative supply shock, the type that is caused by a trade event, is extremely unusual in an advanced economy. The last one was in the 1970s when there was the oil shock, even if the possibility of the next one is brewing with these trade tensions. To repeat, given the exceptional circumstances associated with Brexit, the MPC would use our flexibility in our mandate, in our remit, to support the economy's transition as much as possible. But there are limits to our ability to do so. We can stretch the horizon over which we return inflation to target, but we would never do so to the point of breaking. And it's the fact that in the UK, as in other advanced economies, if there is a material trade shock, whether from abroad or locally, other policies, including fiscal policy, would likely need to play important roles in supporting the economy. So let me move to conclusion. For now, both a global trade war and a no-deal Brexit remain possibilities. They're not certainties. And the way we conduct policy today is we have to deal with the impact of the uncertainty around those events and how they influence the behavior of households and businesses and financial markets. Now, in some countries where these trade shocks are taking place, those impacts, the impact of uncertainty on their economy, may warrant a near-term policy response as a form of insurance to maintain the expansion. As I tried to show earlier, markets are pricing in much more than this, suggesting a combination of either greater pessimism about trade developments and potentially concerns about the absence of monetary policy or absence of inflation pressures. In the United Kingdom, the combination of strong initial conditions, including that tight labor market and inflation at target, and the prospect of greater clarity emerging in the near term regarding the UK and EU future relationship, that argues for a focus on medium-term inflation dynamics. Those dynamics will be importantly influenced by global developments, and even more so, of course, by the form that Brexit takes. Our projections today for the economy assume a smooth Brexit to an average of the various outcomes, whether Canada Plus or other potential outcomes. And the reason we make that assumption is because that is the current policy of the government, and you can test it. It is also the preferred strategy of both candidates to be the next Prime Minister. So that's the preferred policy. We use government policy as the conditioning assumption. It's not a prediction of what's going to happen. And unlike the market, we don't weight all the different potential probabilities on the economy. But what we do say is if that were to happen, what we expect, and we would expect that these uncertainties that are very high in the UK would fade. Companies and businesses would take action, business investment would rebound, the housing market would rally, and consumption would continue to grow broadly in line with growing real household incomes. And this would accelerate economic growth, strengthen domestic inflationary pressures, and then from a monetary policy perspective, that would merit limited and gradual increases in interest rates in order to keep inflation at that 2% target. And it's unsurprising that that scenario is different than the scenario that financial markets are currently pricing in, because financial markets are putting some weight on the no-deal Brexit and cuts in that event. That doesn't mean the market is wrong and the MPC, the Bank of England, is right about the likely outcome of the negotiation. It just highlights the extent to which interest rates, sterling and other UK asset prices might increase if a deal were reached. And we'll explore, for those who read our report, how best to illustrate that in August. Well, most importantly, we'll make a detailed assessment of these global factors and their potential implications of that sea change for the UK economy. What I've sought to illustrate is that whether current trade tensions shipwreck the global economy or prove to be a tempest in a teacup, they will have important influence on the outlook for growth and inflation in the United Kingdom. That's as close to central bank humor you're gonna get. However these external tensions evolve, however Brexit unfolds, we will respond. We will respond to any material change in the outlook. We'll adjust policy in the appropriate direction as required to bring inflation back to target, its 2% target, while supporting jobs and activity in this most important transition for the people of the United Kingdom. Thank you very much for your attention. I'm happy to take some questions.
We're happy to take a few questions. I'll take them just so you're aware. Right. The Governor has very kindly agreed to take a few questions. Because there's no doubt going to be lots of them, I'm going to try and take them in threes. Please, can we have the normal rules, questions, not statements. If we start off with the gentleman here in the front row. If you could please say who you are. There will be a microphone coming your way. And then after that, it'll be the gentleman over there.
Yeah, thank you, Chair. I'm Councillor John Gray from the London Borough of Newham. I'm also the Cabinet Lead for Housing Services in Newham. I'm not sure if you for the previous session, when there was like cross-party support, including by the new chair and the past chair, for the role of councils building new homes. And bearing in mind, if we do have these trade shocks, and you did mention possible fiscal measures, would councils being allowed to build and given the money to build more homes be one possible fiscal measure?
Yeah, just take it on. And the gentleman, I think, in the back row there. Sorry, lady. Apologies.
Hello, I'm Sue Howarth, a councillor from Bolton in Greater Manchester. May I ask you, Governor, you described that the Monetary Policy Committee and you as Governor will constantly assess the economy through Brexit, and you described the limitations perhaps of monetary policy to trade tensions and so on, and the role of fiscal policy at that time. Will you be looking at changes in England should finance seek to appear in the economy to be moving further south? And where you may see will you be wanting to have a look at change across the regions, and where we have an anxiety that we will suffer somewhat in the north of England? Is the Bank of England going to look at the regional areas, particularly where we've got devolved governance, as you know, in Greater Manchester and in the West Midlands? Thank you.
Great. And the microphone number 4 over there.
Hi, Rachel Smith-Light, East Suffolk Council, newly elected District Councillor. I just wondered if you have any thoughts on the activities of Extinction Rebellion, or any you're actually willing to share with us at the demonstrations in London in April. Thank you.
Governor.
Okay. Okay, let's take them in order, and they're all fantastic questions as expected. Look, on the house building side, I didn't actually catch that bit of the session, but let me give you my quick assessment of things, which is, from memory, council house building last year, something like 2,500, 2,650, or I have in my head, but something in that order of magnitude relative to, let's say around 100,000 type need. So call it 2.5% of need. So pretty large gap, and structural. You're more familiar with structural and other reasons behind that. So you have a need, or we have a need is a better way to put it. We have a need. First point. Second point, that in fiscal expansions, if there are projects ready, the biggest multipliers, biggest bang for your pound is infrastructure spending, of which housing, social housing is a prime example, because it goes all the way, as you can appreciate, it provides a need, but it also goes all the way through the construction and other chains, and there's potential that construction would be weak, at least initially, in that circumstance. So it's for others to make those types of decisions, and they have to trade off against various things. But the general point, the thrust of your question, is correct. For Sue, in terms of finance and regional finance, I answer that a couple of ways. One is that first, finance is a little more distributed across the country than is generally recognized. And of course, Bournemouth is a classic example with JP Morgan and Barclays. You have thousands of people working here directly in financial services. And of the 1.3 million people who work in financial services across the country, it's sub 400,000 that are in London and the southeast, so distributed. But it could be much more distributed, which is the spirit of your question. And I think a lot of the answer around that is going to come from new approaches to finance, and that's not something far down the road. That's something much more near term, and I'll give two examples quickly. One is around digital banking. A lot of the digital banks that we have approved in recent years are based in the Midlands, in the north. I mean, I have one, I shouldn't plug it, but I can think of it. It's in Durham, and it begins with an A and ends with an M and has 4 letters. But as an example, because there's a lot of skill that's there, and once you're digital, you don't need to, it's the obvious point, you don't need the physical presence. But as big a thing, and our view is a bigger thing, and this is going to segue into Extinction Rebellion in a second, somewhat improbably, but it will, which is last week, at Mansion House, we announced a series of initiatives, the bank announced a series of initiatives to support the future of finance and to support the fintech sector as a whole. And won't bore you with all the details, but it's basically changing how we operate and the plumbing, how we use data so that the private sector can innovate and provide much better service. And one of the biggest things in this is around the SME, the small, medium-sized enterprise sector across the country. Half of the SMEs in this country do not have access to finance. They don't seek finance from banks. They don't have alternative suppliers. They fund by either taking a mortgage on a flat if they have a flat, or they borrow on their credit card, or they just don't have the capital to get the business up and running. And a big element of that is around information and the use of information. And we are very strongly of the view, and we're putting in place some things to get this happening, effectively to have portable credit files that aren't just about the basics of the business, the cash flow of the business, but and I hate to use a technical term, but the sociograph, the information that is gained by the users of the product and how they how often somebody comes to their website, how long the order lags, and other factors. And you can finance much more efficiently if you have all that information, and even better if you can port it around to different providers. It's a £20 billion funding gap today in the UK, 22 billion, and one can close at least half of that by taking new approaches. And that's we think, a big element of how you help to fill in some of the pressures here. Before I gave that speech, you may have caught that there was a protest, and the Chancellor and I were giving that speech, and there was a protest. It was a few environmental organizations were there. In terms of the specifics of the right to organize and to protest and express views, I will definitely leave that to the experts. But I think it's important to make a point about where the United Kingdom, and particularly the UK's financial services sector, is in addressing the fundamental issues about how are we going to get from where we are today to the objective, which is a net zero economy. And this country is leading in finance, to be absolutely clear. If you take nothing away from what I'm about to say for the next minute, it's absolutely leading. 4 years ago, the UK and the Bank of England was heavily involved in this, commissioned the private sector to set up a way of making sure that public companies disclose their carbon footprint and what they're doing about it, how they're going to get from here to there, lowering their carbon footprint. There's now $110 trillion of assets, all the world's top asset managers, top banks, insurance companies, sovereign wealth funds, et cetera, demanding that these standards are now met. The government just announced today that they would expect to make these mandatory in a few years as they refine. It was an announcement that came out today. So first thing, if you're going to manage something, you have to measure it. We put in place, the collective we put in place the way to measure it. The second thing is to make sure that those risks are managed. What you don't want, none of us want, is the financial sector to say, oh, it's a great idea to move to net zero, but we're not ready yet. We have too much exposure to a certain industry that'll be hurt by that. And so the Bank of England, and what I announced after the protest was over, and was not reported, I have to say, what I announced is that the UK, led by the Bank of England, is going to be the first country to stress test the financial system, our banks and insurers, to make sure they're ready for this adjustment, that they've thought through where their exposures are, that they have a strategy that's consistent with it. And those combinations, and by the way, there's a big chunk of our industry that wants us to do that because they want to learn better how to manage these risks. And the combination of those, and I can give you other examples, but I've exceeded my time already, but the combination of those means that provided the public policy continues to come in place to reduce emissions, the financial services industry will be there to help not just manage the risk, but seize the opportunities. And that fact will start to pull forward adjustment in a way that a number of the protesters and other, and let's be clear, I mean, the citizens of the country want to see happen. So I would stress the financial system is moving very much in that direction.
Wonderful. Thank you. I think we've just about got time for 2 more quick questions. I understand there's 2 up the top there. Paddle 1.
Victoria Harvey from Central Bedfordshire Council. When you're talking of climate change, how much is the low carbon transition able to deliver in terms of jobs? Can it transform the UK? Can it transform our high-skilled economy? Or is that just hopeful expressions from climate change campaigners? And the second question is...
Sorry, Victoria, we'll have one question for you. Sorry, I thought there were 2 separate people with 2 separate questions. I'm being a bit mean, but that's fair. Right, if I have the number 4 over there.
Thank you, Mr. Carney. Can I thank you for coming today? My name is Alan Marsh, and I'm Kent County Council. Could I please congratulate you on your 2% inflation target? I don't think you got the deserved applause that you should have got. It's not that easy. Thank you, Carl. Thank you. Can I just quote quickly at you, I'm aware of the time, global trade war and Brexit are only possibilities of impact, and the markets are pricing in much more in uncertainties. Financial markets put extra weight on a no-deal Brexit. The FTSE right now, 7,562. It's up 65 points. Could I ask you for your judgment and say, in your opinion, sir, are we actually losing this battle or are we winning? Thank you for your time.
Yeah. Okay. Why don't I take those reverse order, Alan? Thank you for reinforcing the 2%. It's exactly that type of reinforcement that keeps inflation at 2%, because we remember that it's important. And in all seriousness, of course, in your day-to-day lives, I mean, you see the impact of both high and variable inflation and financial instability on, the citizens that you serve who are the least well-off are affected the most by the things that we try to keep under control. In terms of, I think it's very important when looking at UK financial prices, particularly equity prices, is to distinguish between that which is international and that which is UK focused. And so the FTSE has performed well because 50% of the FTSE is dollar priced and is entirely international. So sterling goes down, the FTSE goes up. Absolute converse. UK, I'll give you one figure to make the point. UK focused equities, so the companies on the stock market that sell and trade in the United Kingdom, I think a bank that is exclusively focused on the United Kingdom or a UK retailer, there'll always be 1 or 2 exceptions to this, but they're down 45% relative to the United States, okay? 45%. That is one estimate. Doesn't mean the market's right. But that plus, sterling being down 15% plus, that's an estimate of a lower real income in the future for a period of time. It doesn't mean forever, and again, it doesn't mean the market's right, but the market in aggregate is pretty clear in terms of what its assessment is on the medium-term impact. Our job is to help smooth that transition, and then all of our job is, whatever happens, is to make the most of the opportunities that come when Brexit happens and when the new relationship is there. Now I'm down to less than a minute. So and this goes to only one component of the answer, irrespective of Brexit, but it would be important in it. Victoria's question around jobs and the low-carbon economy. Look, there are examples in specific industry where there's clear UK absolute competitive advantage, and that goes from material sciences, the types of materials would be necessary for lighter products, you think from graphene on out, to very much artificial intelligence. I mean, a big element of energy optimization will be through AI, and from DeepMind on. This is a core expertise here, which is not just going to be applied here, exportable. I mentioned on financial services and the UK lead there. I firmly believe that. That is an expertise and a technology that can be globally exportable. I know we don't think of financial services as technology, but it is something where the UK is incredibly well placed and will widen its lead in my view. Last point, but none of this happens overnight, and so what's crucial is to have a clear destination and a transition to that destination, and that will maximize the chances that the jobs are there when we need them for this transition. So there are bad transitions to a net zero carbon economy as well, and a very last point, the worst one is you wait a long time and then you do it all at the end. My university strategy for exams is not a good strategy for low carbon.
Hold on a second. Can we just say thank you very much for that excellent speech and question?